I also wanted to review very quickly the tools that economists use to keep track of gains from trade. And these tools, in their simplest form, are going to be consumer surplus, how well off are buyers when they're able to buy a product, producer surplus, what do producers gain in the short run from being able to produce this product. Warning, it's not the same as profit. It's actually the same as profit plus fixed costs. And then finally, deadweight loss. We keep track of how market outcomes deviate from the theoretically best possible outcome where marginal revenue is equal to price, where price and marginal cost are equal. I'll show you what that means in a moment. So here we go. Let's again think about the Tesla example. And let's just, I'm playing around with my settings in my graphing software. Anyway, let's think about that Tesla Model 3 again. So we've got quantity, cars per month, price, dollars per car. We've got this demand function. And we're going to go back to our usual framework where we think of the firm having maximized a certain ISO or a certain profit, and we're going to represent their profits by this ISO profit line, all the set of points where profits are equal to the same amount, whatever that amount is. The marginal cost curve is upward sloping, and notice that the marginal cost curve and the ISO profit line intersect at the minimum of the ISO profit line. So we know from our extensive work with this model that the firm does best when they sell Q naught worth of cars and the price per car. This is a firm that sells all cars at the same price. So by assumption, we're simplifying. And let's, just for simplicity, let's assume we have the marginal cost all the way to the y-axis. All right, well, that's our outcome. Hopefully all of you can explain how come that's the best outcome for the firm. Remember, we have the feasible set, that's the demand curve, and then there's the series of ISO profit lines that includes the ISO profit equals 0 line. Anyway, there's this series all throughout this space. This one is the highest that the firm can reach. The tangency occurs at P naught and Q naught. Any other combination of price and quantity in the feasible set would have the firm earning lower profits. All right, well, welfare analysis. Let's think about this. The way we think about consumer surplus is we realize that the first buyer would have paid this value. Is that dark enough? That's not really very dark. The first buyer would have paid this amount, but they only had to pay the price. So whatever this was, let's say the price was $30,000, this buyer would have been willing to pay $60,000, but only paid $30,000. So they got $30,000 worth of surplus. The second buyer would have paid $55,000, but only had to pay the $30,000 price. Anyway, and so on. We can calculate the surplus for all people that bought Model 3s. It's going to be the area underneath the demand curve and above the price line. So this is going to be consumer surplus. CS. Now, producer surplus is another matter. Let's use yellow for producer surplus. Here, in the short run, if the producer can cover their marginal costs, that's not working the way I wanted it to. I wonder if this will work. Nope, didn't work. Anyway, let me go back to the drawing board a little bit. Here we go. Let's use red for producer surplus. The producer gets the price for the first car sold, but would have been willing to sell that car as long as it could cover its marginal cost. So the difference between marginal cost and the market price and the marginal cost of producing that first car is the producer surplus associated with that first car. If we counted up all the gains to producers over all the cars sold, the difference between the price and the marginal cost curve over the entire range of output, there we have producer, oops, I changed color, producer surplus. All right. And then there's only one more element to discuss, and that is our deadweight loss. What is deadweight loss? Deadweight loss refers to, let's use, what have I used already? Let's see what this black does for me. Well, let's use yellow, see if that works for deadweight loss. Anyway, for deadweight loss, notice that if we were at the best outcome, that yellow is really dim, but if we were at the best outcome, where every unit that was valued by at least as much of the cost of producing it was produced, we'd be at this level here. We'll call that Q star. Anyway, if we were at that level, we would have earned this whole area of total surplus, the whole area underneath the demand curve and above the marginal cost curve from 0 to Q star. That's the theoretically best outcome possible for society. That's where the total surplus, the sum of consumer and producer surplus, would have been at its highest. So we didn't get there, and in fact, total surplus is smaller than the best it could possibly be by this amount that I'm shading in yellow, by the area of the maximum possible total surplus that didn't get realized. So we'd call this deadweight loss. Okay, got it. And something weird was going on. Deadweight loss. And we call it loss because it's surplus that nobody in society got. So again, the main elements of welfare analysis: consumer surplus, area below the demand curve above the market price; producer surplus, area below the market price above the marginal cost curve; the deadweight loss, the difference in total surplus from whatever market outcome we're looking at relative to the theoretical best possible outcome.